Hello, everyone, and welcome to Investing 101 by LaToya, the Guru. There will be a series of videos pertaining to investing and different types of investing, but in general, when we speak of investing in finance, there are hundreds of terms. So I just want to briefly cover a few that are the most commonly used. As we get further along in the videos, I will use more terms and I will explain terms as they are used or referenced. Also, in general, unless necessary, I do not like to use big words. I don't see the point in using SAT words to impress anyone unless it is necessary. So, let's begin. What to expect. In the next slide, I'll introduce myself. We'll cover what is investing, why you should invest, why maybe you shouldn't invest, types of investments, investment terms, and then a conclusion with my contact info. My name is LaToya. I am a native of New York and New Jersey. I started investing in high school with the stock market. I have a passion for credit investing, trading, and real estate. I've bought and flipped land, I've bought and built homes, and currently I wholesale investment properties and I invest and trade in cryptocurrencies. What is investing? Simply put, investing is putting money or funds into financial shares, schemes, property, or business venture with the expectation of achieving profit. It may be an individual, pool, or group of investors, business, or corporation. Why invest? Generate multiple streams of income. That's usually why most people invest, right? So you have residual income and you have passive income. Passive income is usually retirement or of that nature. So that is the second point, to produce higher or quicker retirement alternative, right? So we all know about the pension check that you get when you retire, but for some people that's not enough, so they need to generate additional income. Achieve financial freedom. At the end of the day, that is usually the goal. Why not invest? Maybe you don't want to pay taxes. With anything that you invest in, whether it's a gain or a loss, you will have to pay taxes. Maybe it's too risky for you, right? So it's not guaranteed that you'll make money. No matter how many videos or blogs you read about people telling you how easy it is to make all this money. Maybe you're not willing to invest time and energy into research, which research is the first step in investing. Maybe you're skeptical of making legit money, which is understandable because you will have a lot of people reaching out to you, especially on social media, like, oh, comment info will now inbox you, and then they'll usually tell you to go to their website, you have to pay these fees, and then you'll never see money that you were promised. Or maybe you're just not passionate about the potential future. It's maybe like, well, I'll see how life is going now, and then I'll think about it later. Types of investments. So you have stocks, ETFs, mutual funds. You have cryptocurrency. You have crowdfunding. You have peer-to-peer lending. You have real estate, which is also known as RE or RE. And you have real estate investment trust, which is also known as REIT. I will detail each in later videos. I'm just trying to keep this video very brief. Common investment terms. So I will use a lot of examples and many are monetary. So you will see K equals 1,000. So 30K equals 30,000. M equals million. 20M equals 20 million. M is a Roman numeral for 1,000. So sometimes you'll see MM, which is 1,000 times 1,000, which is 1 million. Capital, equity, assets, liabilities, cash flow, profit and loss or P&L, gross/net, cap rate, return on investment or ROI or quarter/fiscal year. Equity, also known as owner's equity, value of assets and value of liabilities, owner's share of assets. Positive equity means that your valuation is greater than the amount that you owe. Negative equity is the amount that you owe is greater than your valuation. Most commonly, we'll hear about equity in the house, right? So let's say you paid $200,000 for your house and you put 20% down, which is 160,000. Let's say that you go and get your house appraised, right? Shortly after. Let's say that your house is worth the 200,000. Right now, we're talking about like you get it appraised like before you get the house. So it's worth 200,000. Put down 20%, which is 40,000. Your loan balance is 160,000. Therefore, you have $40,000 in equity, which is why many lenders do encourage you to have a down payment because it helps with equity so that you can try to avoid the possibility of negative equity. In many cases, it may be unavoidable because markets do change, sometimes out of our control. So that's just an example. Capital. That is referred to as the initial amount of investment contribution. For example, if I fund an investment account with $5,000, that $5,000 is my capital. Now, if I receive $5,500, the additional $500 is my gain or profit, which is subject to taxation. Capital loss and gains will also be covered in a later video, which covers taxation. Assets and liabilities. Asset is owned and provides future economic benefit, has value or valuation which contributes to overall portfolio and net worth. Not necessarily does it always have to generate a cash flow. Types of assets. You have tangible assets, which are physical assets like properties, buildings. You also have liquid assets, bank accounts, retirement accounts, which means that it can be turned into cash for immediate purchase. Business property, inventory, and equipment that is subject to also depreciation credits. A liability is an obligation, expenses. Money is paid to upkeep. In general, you always want your assets to be greater than your liabilities, right? Own versus owe. Revenue versus expenses. Cash flow. Cash flow affects liquidity. Amount of money being transferred in and out of a business. You'll have what is referred to as a cash flow statement or statement of cash flows, which shows changes of cash inflows and cash outflows in three areas of business: operating, investing, and finance. Profit and loss, also known as the income statement. The financial statement that measures a company's revenue and expenses over a certain period of time, monthly, quarterly, semi-annually, annually, and is to determine net income. Now, generally speaking, for previous companies that I worked for, it's usually on like a monthly basis or quarterly basis. I know that when you have your own business, such as myself, you can choose your period of time or your term that you want your profit and loss statements. Gross and net. So gross is the total amount before expenses or taxation. Net is the amount after expenses or taxation. For example, if someone works 40 hours and they make $20 an hour, their gross weekly paycheck is $800. Now, after factoring taxes and deductions, your net paycheck will be $640 per week. Now, this is just factoring 20% tax rate. This is not factoring any medical benefits or anything. I just want to keep it pretty basic just for example. Also, if you purchase an investment home for $10,000 and you sell it for $50,000, the listing fees and rehab cost about $15,000 altogether, right? So your gross profit is $40,000 since you sold it for $50 and you only paid $10K. But your net after expenses is $25K. So this is your net income after your expenses. Cap rate, also known as capitalization rate. Ratio of net operating income or NOI to asset value. Renting out a 3-bedroom house for $2,000 a month. That's $24,000 a year. Your expenses are as follows. You have real estate taxes for $4,800 a year. You'll have your vacancy rate of 5%, which is $1,200 a year, and other expenses such as maintenance or upkeep, landscaping, $2,000 a year. Your total expenses will be $8,000. Your annual net income is $16,000. So that is your annual rent received minus your expenses. So let's say the asking price for the home that you're selling is $200,000. So it would be your annual net income divided by your asking price, which means that your cap rate is 8%. Return on investment, ROI, ratio of net profit and net worth. High ROI equals favorable gains. Low ROI, your expenses are pretty high and you have a lot of liability. Example, net profit is $200,000 and total assets are $400,000. Your ROI is 50%. It's not too shabby. Quarter or Q, fiscal year or FY. Quarter is 3-month increments. January through March, April through June, July through September, October through December. Fiscal year, a company's financial measurement period. Most frequent is January through December. I've seen July through June, and in other instances, March through February. So, for example, we're going to refer to a January to December fiscal year. As of this month, February 2018, this is Q1 FY18 or first quarter of fiscal year 18. Thank you for watching, listening, and reading. My contact information is displayed. You can contact me on Instagram at LaToya the Guru and Facebook, Self-Made, Self-Taught Strategic Investing, Business Ownership, and Credit. The links are listed for you below. Thank you.